Fed policy right now is actually harming the economy, but not in ways that normal tightening would. They're not taking the heat off of inflation. That was already done when the supply chain was undisrupted. That was done when the US government stopped handing people free money.
Experience an enlightening exploration of inflation as Danielle DiMartino Booth, a renowned expert, sheds light on its various forms and sources. Discover the impact of the trade war, supply chain disruptions, and trillions in direct stimulus. Gain insights into the Federal Reserve's tightening policies, housing affordability, and business investment. With Danielle's expertise, understand the driving factors of inflation and their economic implications. Join us for a captivating journey into this crucial subject.
What caused the inflation to begin with? It started with the trade war and that first Trump tweet way back years and years ago. That's when the supply chain disruption began. And then it was amplified and completely exploded after the pandemic hit. On top of that supply chain disruption, then you had trillions and trillions and trillions of dollars of stimulus printed, directly deposited into people's checking accounts. You bypassed the banking system. That's why Ben Bernanke could never hit that 2% target, because the stimulus was going through the banking system to households, to companies. What the stimulus did was bypass the banking system. No credit check. We're just giving you money. And you know what? People spent it. So the inflation that proved so elusive to Ben Bernanke exploded when the transmission mechanism was removed. And by the way, the Fed was the enabler monetizing every last penny of those trillions of dollars. By the time the Fed stepped in and started tightening, the supply chain disruption had been mostly unwound, which is disinflationary, and the fiscal stimulus, right? That third large fiscal check was mailed out in April of 2021. Fed didn't start hiking until March of 2022. So they were too low for too long. But by the time they got to the party in March of 2022, most of the disinflationary pressures had already filtered through and started to bring inflation down. So what the Fed did was basically add insult to injury. In fact, I would argue that the Fed's tightening policy, Jack, has been inflationary to housing. How does that make any sense? Well, people are locked into 2.5% fixed rate mortgages. So when the Fed started tightening, you exacerbated the unaffordability aspect by making those payments even higher against the backdrop of people who will not sell their homes. So now we wait. And this is where we get into the different components of inflation. But it's really important to understand that when the Fed started tightening, what they ended up doing was curtailing housing worse. They made housing more unaffordable than it was. And at the same time, curtailed business investment because a credit crunch followed them. So now you've cut investment off. So the Fed policy right now is actually harming the economy, but not in ways that normal tightening would. They're not taking the heat off of inflation. That was already done when the supply chain was undisrupted. That was done when the US government stopped handing people free money. Had this big pop in January and February in Manheim. Auto dealerships were anticipating a very robust individual income tax refund season that never manifested. But that doesn't matter. They increased their lines of credit. They went hauling into auctions, overpaying for cars, pushing that Manheim index up in January and February. That flows through to the CPI in a big way with a 2-month lag. And that's why we saw last month, we saw that 4.4% print on used car inflation, even though used car prices have now been falling. And they will continue to fall according to what Cox is telling us right now. I mean, if you look at what you just pulled up, total retail inventories, this is fresh data that we got out. Look at inventories without cars. That green line includes cars. That's a hockey stick. Those are dealerships having their lots refilled. And that's why we're seeing incentive spending double off of what it was last year. But non-auto retailers, retail inventories, that yellow line, they've already peaked and started to come down. We're going to see that increasingly because you heard from the CEO of General Mills who said the catchword, the global catchword right now, destocking. Destocking. Customers are holding less inventory. We're seeing not just a reversal of going from just in time to just in case, hoarding inventory. We're seeing a correction beyond that to now where they're holding less inventory than they did prior to the pandemic. And this is something that an entire generation of operation managers have never had to deal with. They've never had to account for financing in real time. This is your shortest term financing, which by the way is your most expensive. They've never had to finance the inventory on hand. So their bosses are telling them, get rid of this stuff until final demand comes through. Craig Fuller, my good friend at FreightWaves, has been saying, it ain't happening. Inventories are not coming back. We see this through freight. And by the way, we're starting to see high-end consumption turn. He tweeted that out a few days ago. I followed up with him and he's like, it's happening, Danielle. That's a big deal. But again, what we're seeing this flow through to is destocking. When customers are holding less inventory than they had before, supply demand, you're seeing the reversal and then some of the supply shock that created inflation. Whether you're talking about small businesses, the service sector, or the manufacturing sector, I had like a triple chart of those three in the views of the vendors supplying all three sectors of the economy. They view their customers' inventories as being too low compared to long-term. There you go. Those red dotted lines, those are the long-term averages for these data sets. And as you can see, we have gone below those levels across the board. That's destocking.
So, and it needs to say, nearly none of this has to do with the monetary system, how much money there is, the cost of that money, interest rates, things that the Federal Reserve has a lot of control over. This is all in the real economy, real stuff, not ones and zeros on screens. So is the narrative that there used to be nowhere near enough stuff to meet the demand? Cars needed these semiconductors, these advanced chips that were not coming into place. So everyone wanted a car and no one could get one. Are you saying that right now we have the exact opposite of that?
We have the exact opposite. We actually have a glut in the semiconductors that are used to make cars. Again, we've had a full reversal and then some. Now we have too much supply and too little demand chasing it. That's disinflationary by definition. And by the way, Fed policy does influence destocking to the extent, again, that you have to finance the inventory you're holding at the shortest rates. That's operating finance. That's the highest money that you can spend to carry inventory. So there's a double incentive to get rid of it because the demand's not there and it's expensive to carry it.
Danielle, now let's move on to another sector, which is housing. So many people, including myself, said, mortgage rates go from 3% to 7%. That must really crush demand for housing. It kind of hasn't. And we're actually seeing, housing prices go up after falling down because people who are living in their houses and they have a super low mortgage rate, they don't want to move because they'll get out of that mortgage. So people who want to buy houses have to go to the new home market, the home builders. Those stocks are on a tear, by the way. And so I want to ask you about that. And that's how the bullish narrative, the optimistic, the green sort of shoots narrative. But there's also something much more dire in the multifamily world, in the single family hold, as well as particularly Airbnb. So tell us, what are we looking at right now for folks who are listening to this on a podcast, as well as people who are kind of having to squint and look at this table, because this really is quite alarming and interesting.
It is. It's fascinating. If you want to take a vacation in the Poconos, go for it. The price to rent an Airbnb is down by more than any county in the country, in Monroe County, where the Poconos is, in Pennsylvania, down 52% year over year. Now, the difference between the organic homeowner in the Poconos is that they've got this mortgage at 2.5%. They've got equity built up in their house. I call them the Airbnb jocks. They did not put down maybe 15% down payments, and they can get around some of that. And the mortgage that was underwritten was predicated on cash flow, and constant cash flow, by the way, in order to service the debt. So people say that this housing market is completely different than the housing market in 2006. That's correct. You don't have a bunch of subprime borrowers, but there's another chart that shows this baton handoff between organic home sellers not putting their homes on the market and the sheer number of Airbnb rentals that are out there. That's in the slide deck that accompanied that in the quill. So Airbnb,
this one?
that one.
Yep.
Yep.